Welcome to Trading Nation. I'm Courtney Reagan. I'm joined now by Jim Paulsen. He's Chief Investment Strategist at Wells Capital Management. He's joining us by phone today. Jim, thanks so much. It's, really been a good start for the year for stocks. Of course, we're giving a lot of credit to the Trump rally. Do you think that they keep rising from here, or are these promises sort of already baked in?
I'm one that happens to believe that this is a much more fundamentally based rally, Courtney, than just Trump. Trump could be a headline catalyst any given day, like yesterday morning after the speech. But I think the real ammunition for this rally is just a steady stream of really good economic and earnings momentum information, not only coming from the United States, but just globally now. We've got the first synchronized sort of acceleration going on from all corners of the globe at the same time, and we got a reignition of the earnings cycle that's coming with that. And I think we are awakening the animal spirits, and this thing has got a lot more fundamentals. So, yes, I think it's going to continue on to higher levels, and yields are going to move higher yet, too, this year before we get a significant correction possibly from higher levels.
And it looks as if the odds are gaining more steam in favor of a March rate hike. What do you think that does to the market, and are you looking at specific levels that our viewers can be watching here?
Well, my guess coming into this year, at the end of last year, was we might rally as up in the S&P 500 and breach 2,600 at some point this year. But I also think the 10-year yield might reach as high as 3.5% at some point this year. So I do think yields are going to go quite a bit higher. Ultimately, I think rates will bite the stock market, and we may get a pretty hefty correction. But I think it's going to start from much higher levels in the stock market than we are today. The real question that I think investors focus on today is, well, what level do rates bite? Right now, rising rates, the fact that the Fed's willing to raise them, I think is a confidence builder for equity investors that the economy is moving away from deflation and the deflationary abyss. The economy is getting better, good enough to produce inflation. But at some point this year, that optimism is going to turn back towards pessimism that rates are getting too high and maybe break the momentum. I think that's from higher levels, as I say, than we are today.
So would it be that pessimism that you're describing that could potentially derail the rally and pull us back from that 2,600 target on the S&P that you mentioned?
Well, I think right now the mindset of investors is that rising inflation, the fact that the Fed's forced to raise rates, is actually a good thing. It's looked at as more as the economy is getting better, earnings are getting better. Ultimately, though, I think that mindset's going to shift yet this year to where people get more worried about inflation as a real threat, more worried that the Fed's behind the curve, and higher rates become a negative for the market. One thing I'm watching, Courtney, to give me a sense of that is the correlation between stocks and bonds. That's positive right now and has been positive, but since the late 90s, that has turned negative 3 times, in late 99, late 06, early 07, and in 2014. And every time that correlation went negative, the stock market then struggled. So I'm looking for that correlation, which is currently positive. Once that turns negative again, then I think I'm going to turn more negative on the stock market overall.
You've given us several markers to think about when we're watching this market going forward, so we appreciate your time. Jim Paulsen of Wells Capital Management, thanks for joining us today, and thank you for joining us on Trading Nation. I'm Courtney Reagan.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.